In today's episode, we'll break down two important stories. First, we'll talk about Amazon going for the quick commerce spy, and then we'll do a sweep of the recent regulatory changes in India's financial system. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. If you're listening to this on your commute, on a walk, or at the gym, you can also find the Daily Brief as an audio podcast on Spotify, Apple Podcasts, or wherever you listen to your podcasts. If you prefer reading, check out the newsletter using the link in the description. I'm your host Akshara, and today is Monday, 6th July.
Hi folks, sorry for interrupting your daily schedule, but this will take just a short bit. My name is Krishna. I am part of the Daily Brief team, along with all of my other colleagues, Pranav, Kashish, and a bunch of other people. So it's been about 2 years of markets, and today is also our 500th episode. So I just wanted to take out some time and say a big thank you to each of you who listen to us, watches us, reads us on an everyday basis, and writes to us. We are very grateful that some of you find value in the work we do. The comments that you do, the likes that you give, or the emails that you send us, that really keeps the journey going. And there are a lot more things we are planning to do, one of which is Subtext, which is our conversations or podcast initiative. We'll release more details on it soon. But if you have any other ideas that we should be doing, any other feedback that you have for us, please do comment or mail us. I'll link it here somewhere. But thank you so much.
Coming to the first story. So Flipkart and Amazon were the original heavyweights of the e-commerce business. And if you asked us who would lead the quick commerce race back in 2020, they would probably be the obvious answer. They had everything from seller relationships to warehouse networks. So how could they not win? Of course, that isn't what happened. The industry was born out of food deliveries, not e-commerce, when Swiggy started experimenting with deliveries under an hour. And then, out of nowhere, the upstart Zepto famously launched with its 10-minute delivery promise. Soon thereafter, the new avatar of the once fledgling Grofers, Blinkit, took an unmistakable lead. And these are now the three industry champions. From whatever we've read and the people we've spoken to, it practically seems impossible to beat them at this point. Still, given the sheer volume of action in the space, many new players have jumped into this race anyway, led by Amazon and Flipkart. In fact, that push seemed to be on the top of Amazon CEO Andy Jassy's mind when he visited India last month, when he announced that the company will take its quick commerce service Amazon Now from 100 cities to 300. That's a massive commitment for a company that currently just has around 500 dark stores in India. Meanwhile, Flipkart's quick commerce arm, Flipkart Minutes, went from basically nothing in mid-2024 to over 1,000 dark stores today. And that's the story we're telling today. But before we get there, it helps to understand why today's incumbents feel as confident as they do right now. So the three companies that dominate quick commerce today have spent years losing money on every single delivery. And that spending is, in part, why they have the positions they enjoy, with Blinkit capturing almost half of all orders, Zepto a third, and Swiggy just short of a fifth. Now, this enormous spending blitz is all but baked into how the business works. Each delivery costs these companies roughly the same, whether a customer spends rupees 200 or rupees 5,000. These companies braved that cost anyway to get people to order. They kept discounting and offering free deliveries even when the order value was well below what was worth it for them. That was the cost of creating this market. But over the past year, the giants have started tightening their belts. They introduced platform fees and handling charges, raised the minimum order value you need before a delivery is free, and pulled back on discounts. And it paid off. Blinkit reported its first operating profit in the January to March 2026 quarter, rupees 37 crore in adjusted EBITDA. Swiggy Instamart said it was on track to achieve contribution margin break-even by the June 2026 quarter, a fancy way of saying it would stop losing money on each individual order, even if the overall business has large overhead costs it's yet to cover. Zepto finally found the confidence to file for an IPO. The quick commerce industry, for the first time, looks like it might be stabilizing. But the thing that captures this moment the best, perhaps, came from outside these companies. In June, Hari Menon, who built Big Basket from scratch in 2011 and grew it into Tata's grocery platform with over 900 dark stores, stepped down as its CEO. And in his farewell LinkedIn post, he wrote that he had been in denial about the idea of quick commerce for a long time. The idea of a 10-minute delivery seemed absurd and unnecessary at first, and even consumers didn't know this was something they would like. But they did. Now, Big Basket was really a pioneer of grocery delivery in India. It saw the entire trajectory of the sector from start to finish, and this admission was, in a way, the ultimate sign of quick commerce's ascent. Now, the person who replaced Menon, by the way, spent 11 years at Amazon before this. But just as the incumbents are starting to mature, the old guard is making a brand new bid for the business. Why? And why now? So there's a cynical answer that Amazon simply spotted a fast growing market and decided to barge in. It's probably not entirely wrong, but this explanation from Jignanshu Gore, a director at the brokerage Bernstein, seems more interesting. As he told Money Control, till quick commerce was largely focused on groceries, Amazon India's core e-commerce business was not particularly affected. But now that most players are selling tens of thousands of SKUs across categories, the threat to Amazon's broader e-commerce business in India is much larger. So in other words, the old guard didn't step into quick commerce's turf. It was quick commerce that began eating up their market. Now, quick commerce started out as an online version of a regular kirana store. Basic groceries delivered in 10 minutes. If you were baking a cake late at night and suddenly needed eggs at 11 p.m., you opened Blinkit. But then the category kept expanding. Blinkit's product range in Delhi NCR, for instance, went from 35,000 to 40,000 items a year ago to 80,000 today. From a kirana store, it practically turned into a huge on-demand mall. You can now get everything from electronics to furniture to fashion in minutes. And as they grew, quick commerce stopped being a grocery business, turning into an e-commerce business that was 100 times faster. Quick commerce now accounts for 20% of all e-commerce in India, and it's growing at 50% a year. Premium urban customers who once bought everything on Amazon slowly shifted their household spending to Blinkit or Zepto. Amazon now is essentially an attempt to win them back. And this isn't their first attempt. Interestingly, both Amazon and Flipkart have tried fast delivery in India before, but neither could make it work. So Amazon briefly ran Amazon Food, a restaurant delivery business. It shut the service down in December 2022 after spending 2 years and onboarding about 3,000 restaurant partners, including McDonald's and Domino's. Never in that time was it close to competing with Zomato and Swiggy. Flipkart tried something similar in the past, but it never quite worked. But that said, those were different businesses. Amazon Food was after restaurant delivery, which is a completely different operating problem. And Flipkart previously attempted scheduled grocery delivery, not 10-minute quick commerce. But this time around, both are trying to play to strengths they've spent a decade building: supplier relationships, fulfillment networks, and trusting customers. Take Amazon. It already has a 49% stake in more retail and access to Amazon Fresh supply chain in 300 cities. It just slashed commissions to zero on products under Rs 1,000, which is an attractive proposition for brands that are already paying blended take rates and advertising fees as high as 40% on Blinkit. Now, there are some signs it could really become something. One brand founder, for instance, told The Arc that Amazon now already accounts for about 20% of its total Amazon sales. And on the Q1 2026 earnings call, Andy Jassy said that orders in India are increasing 25% month over month, and that Prime members are tripling their shopping frequency once they start using the service. Now, we haven't seen something that hopeful out of Flipkart yet, but as Walmart's Catherine McClay said at a Bernstein conference, Flipkart won't trade away market share and future growth for the sake of profitability. So, in other words, it's willing to spend its way to growth. And you can see that spending in action. Amazon now is offering cashbacks of 50 rupees, 100 rupees, and 200 rupees depending on order size. And Flipkart Minutes is pricing about 10% below Blinkit across categories. So, what could this firepower do? Now, there's a twist. Even as the old guard encroaches on their turf, services like Blinkit and Instamart aren't trying to match them. Having spent years building the unit economics they now have, they don't want to give it up to new competitors. In fact, they even claim that doing so is a bad idea. Albinder Singh Dhinsa, Eternal CEO and Blinkit's founder, recently claimed that aggressive discounting pushes quick commerce companies to poor quality growth, forcing it to subsidize low margin products. Or, as Swiggy Group CEO Sriharsha Majeti told Economic Times, quick commerce is a commoditized market. You either compete on price or on what all you stock. And to him, cutting prices didn't make sense. Consider the views of Deepinder Goyal, who built Eternal, the company that acquired Blinkit and took it to the top before stepping down earlier this year. To him, Blinkit was profitable with half the market. Everyone else, meanwhile, was burning cash at an incredible rate, as much as $2 billion for $5 to $6 billion worth of orders. That is where a company like Amazon, too, is playing. Then again, one remarkable thing is just how much money the old guard could pour into this fight if they wanted, and that alone makes them a threat. Amazon, for example, has more than $140 billion in cash. Flipkart has the American retail giant Walmart's backing. Both have made their priorities explicit. Amazon India's country head Samir Kumar told ET the company was aiming for market leadership in quick commerce. Walmart's Catherine McClay claimed Flipkart won't trade market share for profitability. Neither company cares much for how sustainable these businesses would be right now. They are in it to win. Perhaps the worst hit will be Zepto simply because of the timing around these pushes. It's trying to go public at exactly the moment Amazon and Flipkart are opening hundreds of dark stores in the same cities it operates. Now, their presence makes its IPO story harder to tell to investors. Even if they're big now, who knows what happens 3 years down the line? Then again, maybe there's space for everyone. The broader market, after all, is massively underpenetrated. $11 billion sounds large, but it's still less than 2% of India's total grocery spend. And the incumbents have built strong businesses for the premium urban customer. Quick commerce has now gone through a few distinct phases. At first, nobody knew if the idea would even work. And then nobody thought it could ever make money. But now the question is whether the companies that built it can hold on to it. Every time one question is answered, it seems the next one only looks harder. Coming to the second story. Every year, SEBI, the RBI, IRDAI, and the rest of India's regulators keep pushing out rules. Some to make our lives a little easier, most to make the financial system a little sturdier. Individually, none of them is hard to keep up with, but zoom out to a 6-month window and you realize just how much has shifted, and it's not easy to remember all of it. And we've covered a lot of these changes as they landed. Still, ask anyone to list what changed since the start of the year, and they might just draw a blank. So here's what we're going to do. The RBI's latest financial stability report has a chapter that rounds up every regulatory change of the past several months across banking, markets, insurance, and forex. A lot of it is genuinely too technical or too niche to matter. So rather than recite the list, it's more useful to step back and notice the changes cluster around a handful of things that would matter to us. Let's dive in. Now, Indian banking has always had a backward-looking relationship with risk. Under the current RBI rules, a loan that's being paid on time, irrespective of there being a possibility of default and stress, is a standard asset, and it carries only a small, flat, general provision. Only if and when payments are missed for 90 days does the RBI require the loan to be recognized as stress, reclassified as non-performing asset or NPA, and provided for. And even then, the amounts are fixed percentages for the type of loan given, not real estimates of how much the bank actually expects to lose. So risk gets sized up after it's crystallized, not before. And the fixes this year make banks reckon with risk earlier and make them pay for the risk they actually carry. Now, the big one is the change in how banks provision for bad loans. So the RBI is scrapping this old incurred loss framework and moving to what's called expected credit loss, or ECL. It's a system where banks have to estimate upfront how much of their lending is likely to sour and set money aside for it in advance, whether or not there is delay in payments. So loans get sorted by how much their risk has worsened since they were made, and provisioning rises as a loan deteriorates before a default. This is the same philosophy the rest of the world adopted after the 2008 crisis, and it adjusts a bank's reported profit against the risk sitting underneath it. Now, this regulation will officially come into effect on April 1st, 2027, and collectively, banks are expected to absorb a one-time hit of Rs 60,000 crore. Now, the second fix works on the same instinct of risk management from a different angle. See, every bank in India used to pay the exact same price for deposit insurance, which is the cover that guarantees your money in the bank is safe up to Rs 5 lakh even if the bank fails. So the premium for this is a flat 12 paise for every 100 rupees of deposits with banks, whether they're the country's most conservative lender or a cooperative that is one bad year from collapse. That flat rate forced good banks to subsidize reckless ones. Now, premiums are being tied to how risky and well run each bank is. Now, there will be a discount for those that have paid premium for years without ever filing a claim, and suddenly, bad behavior shows up as a bigger bill. So, how much does this actually fix the problem? Turns out, a fair amount in principle. Both changes sharpen the incentive to behave, which is exactly what a reactive system was missing, but neither is a magic shield. So, the second cluster of changes is about our vulnerability to the rupee swings against the dollar and relatedly to foreign money that can flood in and rush out in a mood. Through early 2026, the rupee came under genuine pressure and regulators reached for two very different kinds of fix. One was to stop the bleeding now, while another to reduce the exposure over time. So the immediate fixes were defensive, and there were a lot of them. And the centerpiece was dollar rupee swap deals. So when a bank raises a dollar deposit from an NRI, it takes on currency risk. Essentially, it owes those dollars back in a few years, but in the meantime, it wants to convert them into rupees and lend them out at home. If the rupee weakens over that stretch, buying the dollars back to repay the depositor gets expensive, and that risk alone is often enough to keep banks from chasing foreign deposits in the first place. Now, the RBI swap tempers that risk. So the bank hands its dollars to the RBI now in exchange for rupees, and the RBI commits to returning those dollars at a fixed, pre-agreed rate at maturity. So now the currency risk is parked on the central bank's books instead of the banks, and this makes raising dollar deposits safer. Now, the next lever made those non-resident deposits even more profitable to hold. Normally, a slice of every deposit a bank takes has to sit idle. It must be held as cash with the RBI or parked in government bonds rather than being lent out to earn a return. So the RBI temporarily waived that requirement on these fresh foreign deposits so banks could put every rupee of them to work. The better the economics, the harder banks chase the deposits and the more dollars flow in. And then a third set of moves was about curbing speculation. So when a currency is sliding, traders and banks pile on bets that it'll fall further, and the selling itself drags the rupee down, a self-fulfilling spiral. So the RBI clamped down on the banks placing those bets. It capped how large a net position on the rupee any single bank could hold overnight, so a bank buys and sells the currency all day, and the gap between the two is its standing bet on where the rupee is headed. Now, the RBI limited that gap to $100 million per bank at the close of business, small enough that no one bank could push the market around. So these were all emergency steps. The slower structural fix was about the kind of foreign money India attracts. Now, the worry was that too much of foreign money that came was nimble, opportunistic capital that, when things go south, would leave just as quickly as it came. The old caps on foreign holdings of government bonds tried to manage that by limiting how much could come in at all. But a cap is indiscriminate, holding back patient and hot money alike, and the fiddly rules attached to it actually deterred the biggest, most patient investors who need scale and certainty before they'll commit. Now that's where the fully accessible route or FAR for bonds enters. So by opening a class of bonds foreigners can buy with no ceiling at all, FAR made Indian debt eligible for global bond indices, which bring in passive benchmark tracking money that stays as long as India is in the index. Importantly, that's steadier than the discretionary flows the caps had been holding back. Extending FAR to bonds of 15, 30, and even 40 years plus sovereign green bonds doubles down on that, since 40-year paper is what pension funds and insurers buy. But that being said, does this money show up in size? So far, opening the door widened the pool of buyers, but it doesn't truly manufacture demand for 40-year Indian debt. The third cluster is perhaps the most relatable to ordinary people. You're probably well aware of scams that arrive as Telegram groups promising guaranteed returns and slick advisors flashing fake credentials on Instagram. You might also be aware of cloned trading apps that impersonate real ones, or insurance apps selling you some hidden cover that you never asked for and don't even need. These deceptions are evolutions of old physical tricks that went digital. And with that shift, it's become harder to regulate them. The old model of waiting for someone to complain, then investigate, simply can't keep pace with harm that spreads at the speed of a feed. So the fix here is a shift in tactics. Regulators picking up the same tools as the people causing the harm. So on the market side, SEBI made two moves against digital fraud. It partnered with Google to put a verified badge on the Play Store apps of genuinely registered brokers so you can tell a real app from a scammer's clone. This one is already live, beginning with stockbroker apps, more than 600 of which have been badged so far, and it's set to widen to other registered intermediaries over time. In the same push, SEBI says it has had more than 60 fake trading apps pulled from the app stores and flagged well over 1 lakh misleading pages for takedown. SEBI also switched on an AI system that scans social media in real time to flag guaranteed return claims, fake certifications, and impersonation automatically instead of waiting for a victim to file a complaint. And in insurance, IRDAI went after the incentives. Alongside convening insurers and hospitals to untangle the systemic mess in health claims, it did something genuinely unusual. It tied 50% of an insurance company's top executives' variable pay to consumer facing outcomes, like how fast they settle claims, how quickly they resolve grievances, and remarkably, the elimination of dark patterns that nudge you into buying cover you don't need or make cancelling deliberately painful. These are all real upgrades that shape behavior at a large enough scale. Now, three changes don't fit a theme but are worth filing away. For one, if you once bought shares in physical form and lodged a transfer request that never went through, many got stuck on documentation issues before SEBI stopped physical share transfers in 2019, after which changing ownership required the shares to be in electronic form. So SEBI has opened a one-time window until February 2027 to relodge them and finally get the shares moved into your name and dematerialized. And then the RBI set up a committee to make India's financial system quantum safe, on the logic that a powerful enough quantum computer could one day crack the encryption protecting every bank transaction, and it's better to prepare early than scramble late. Third, the pension regulator approved NPS Swasthya, an experiment that lets you use the machinery of your retirement account to cover medical bills. By doing this, the regulator acknowledges how often a big hospital bill can wreck a retirement plan in the first place. Now, none of these were about grand new schemes. The more interesting question is which of these holds once the pressure that prompted them fades. Now coming to the tidbits. Adani and Abu Dhabi's IHC are building an $11.5 billion aluminium plant in Odisha that will add 2 million tons of annual capacity. The project could shake up India's aluminium sector as demand is set to hit 8.5 million tons by 2030. Coming to the next tidbit. The World Bank has upgraded Sri Lanka to an upper middle income economy just 3 years after the country's worst ever economic crisis. Vietnam was also upgraded to the same status in the same round. Coming to the final tidbit. The Indian government is planning stricter rules for VPN providers, requiring them to set up an office in India and appoint compliance officers who can respond to law enforcement requests. That's all the news I have for you. Thank you so much for watching and see you in the next one. Disclaimer. This content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.